Let's get across the market open now. James Gerrish joining us from Market Matters. James, welcome to Wednesday to you. Let's first start with what we saw on the global session overnight. Chip stocks once again being sold off.
Yeah, good morning to you, Andrew. It was another tough session for chip makers, although they have had obviously a very good run up in the last couple of months. So the momentum is starting to unwind here, and we're starting to see some money flow into other areas of the US market. So money's coming out of these hot momentum-driven cohorts of the US market, and they are filtering into some of the other areas, partially in tech and partially in more economically exposed areas of the US market. So we're starting to see the rally broaden. I think that's a positive thing overall for market structure. But the semis will get all the headlines this morning, Andrew, given the big declines overnight.
Just more recently, James, I'm seeing a number of brokers and analysts pointing to the fact perhaps the hyperscalers are somewhat undervalued. Would you agree with that?
Yeah, I think, if you look at their earnings are continuing to appreciate very quickly. So, my view is that they are probably undervalued at this point in time. But the real question is whether or not those earnings are sustainable. So, are we seeing peak earnings, and is the outlook going to deteriorate from here, or is it sustainable? So, looking at the valuations here and now is only one, piece of the puzzle. You've got to look further out and make a decision whether or not you believe this is going to be sustainable. I think it is. So I think some of those hyperscalers are certainly undervalued at this time for the growth that they're going to deliver in the coming years. So obviously it's a bit of a moving feast around earnings and what they will be, because the dynamics of the sector are changing so rapidly. So it's not something you go really heavy in terms of portfolios. So you've got to be conditional upon sensible weightings across portfolios. But I think having sensible weightings makes sense.
What are you looking forward to in US earnings season? And do you think we're going to get much guidance there?
Yeah, I mean, US earnings season should be really good. I'm hopeful that we see a broadening of the earnings base in US markets, which would underpin, the continued sustainability of this rally higher. So obviously US earnings are going to be strong this quarter. We know that, but we also know it's going to be driven by, quite a small cohort of US stocks over there. I want to see a broadening of that rally into more economically exposed areas of the market. So obviously we started last year with the expectation that interest rates would be cut as inflation cooled. The war put the kibosh on that. So we've seen, we've struggled with higher interest rates throughout this year. And so that's going to have an impact on some of the consumer facing names. Some of the real estate stocks have obviously been hit by higher bond yields. Some of the alternative asset managers have been dealing with some, mixed fortunes in the private credit space, and then asset prices have been really volatile. So I'm really going to be focused on the other areas of the US market other than tech. I want to see the breadth of the earnings base of US markets broadening, and that to me would be a really positive thing for the market overall, and it'd be a really positive thing for Australian investors as well. Obviously the ASX lagged international markets materially in FY26, so we need to see a broadening of the US equity market rally, which would be a precursor, a good underpinning a factor for our local market to recover some of that recent underperformance.
Well, James, speaking of the local market then, pretty quiet news-wise, it has to be said, at the moment. But I see you're actually focused on the insurers at the moment, given how well they have done just more recently.
Yeah, you're right around news flow locally. So obviously we've got full year results coming up in August. We've got July, which is a month when news flow is probably a little bit low. Interesting to note, seasonally, July is a really strong month in equities here in Australia. So in the last 10, 20, 30 years, it's the best month across the board. So that is a positive thing. It's probably around that lack of news flow that markets tend to grind higher through the month before we go into that FY26 full year reporting season in August. The insurers are really interesting here. So the likes of QBE have had a really strong run. We have that in our growth portfolio. And Suncorp we've got as our preferred income exposure within the insurance sector. So Suncorp's been downgraded by a couple of brokers last week. There was a mixed update just around their growth rates over there, this year. So they've obviously done made some changes around reinsurance, which creates a greater, I guess, predictability of their earnings moving forward, but they've just guided to lower growth next year, so that's not a great thing for for Suncorp. But trading on 15 times, yielding near 5%, we still think that stacks up. QBE is a little bit more nuanced because it's got more US exposure. It's had a greater run. It's supported by higher bond yields. So higher, bond yields were 8 basis points higher in the US overnight. So I'd expect QBE to have a good day today. But I think we're just questioning valuations around QBE at the moment. It's trading about 1 standard deviation on the expensive side. So that's one that we own, have done well out of. That's potentially on the outer at some point, Andrew.
James, what about in the smaller end of town? What opportunities are you seeing there at the moment? Obviously, once again, if we can make that comparison with Wall Street, the Russell 2000 doing very well. We do have that headwind just as far as interest rates are concerned here, but more broadly, what are you seeing?
Yeah, it was interesting last year. You make a good point around the Russell 2000. That has been, in the last month or two, it's been the outperformer over in the US market, and that does help support our view that the rally is broadening. Last year on the ASX, the Small Ords did 8.1% versus the large caps up 6%. So the Small Ords that did actually outperform last year, only mildly, but they did outperform nonetheless after consecutive years of underperformance. So that to me again speaks to a broadening of the rally, and we're pretty constructive on small caps. We've written a note this morning just on HMC Capital, which has been an absolutely diabolical stock over the past 12, 18 months for a whole number of reasons, but that looks to be turning the corner. There's a lot of these more complex situations that have got catalyst in the coming months that could help turn the ship around. So HMC around $3 is one that we like here. SiteMinder, SDR, is one that we own that has been under a lot of pressure over the past 12 months. They did a deal recently, or launched a new platform recently, which really speaks to their distribution. So they're really leaning into what is their key core capabilities, and that's in distribution. So we like that one. The lithium stocks you may mention at the top of the segment there, lithium stocks have been really weak, and I can understand why. So we're looking at lithium stocks at the moment. So Liontown Resources would be front and center there. We haven't pulled the trigger and bought yet. I think there's probably more weakness to come on the back of mothball production coming back online pretty quickly. But we are overall bullish on the lithium space, although I have no exposure there at the moment. So that's an area we're looking to add to into weakness, Andrew.